Welcome to the debate. Our focus today is on the colossal reality of modern sovereign debt. We're looking at a global liability that totals around $315 trillion, a figure that, really defines the shape of our financial world. It's been called both the skeleton of the modern world and the heartbeat of capitalism.
And that's a powerful way to put it. When you consider that scale, the U.S. alone holds a $38 trillion liability. We have to look beyond just the raw numbers. The real question, I think, is about how this debt actually functions. Because this debt is designed, from the ground up, to be perpetually rolled over and refinanced, is this system fundamentally a necessary mechanism that guarantees stability and liquidity? Or is it primarily a structural engine for wealth transfer that rests on a very, very fragile foundation of just belief?
Structurally essential for global economic stability.
And I'll be arguing that its structural necessity only serves to mask a profound systemic fragility, and that its primary function really is to drive massive wealth redistribution between financial classes.
Okay, so let's trace this back. The structure of modern debt, it really began in 1694 in England with the invention of the government bond. The state needed funding, and the solution wasn't ultimate repayment, but continuous refinancing, which was guaranteed by future tax revenues. This core design, it still holds true today. The U.S. is not going to pay off its $38 trillion debt. It will simply refinance it forever. And that isn't a failure of the system. That is the fundamental plan. And what's more, this debt provides the crucial collateral that the entire system rests on. Government bonds are, universally recognized as the safest assets in existence. If policymakers were to even attempt to eliminate that $38 trillion liability, the result will be a systemic collapse. And why? Because you would instantly contract the dollar supply, and you'd remove the most critical, safest assets that global banks and pension funds rely on to meet their capital requirements and maintain liquidity. States borrow rhythmically because this debt is the very ground the economy stands on.
I come at this from the angle of consequence. I agree, the debt is structural and its perpetuity is the design, but that perpetuity is the very engine of its true and, I think, problematic function: systemic wealth transfer. If the debt never disappears, the obligation to make interest payments is guaranteed forever. This mechanism ensures that a guaranteed income stream flows from the general taxpayer, who are the debtors, to the capital owners who hold the bonds. It is a direct, massive, and, frankly, a zero-sum extraction of wealth between classes, not just some necessary function of state finance. And while this mechanism is necessary for the system to function as it is built entirely on that very delicate concept of confidence. The high priest overseeing all of this is the central bank. When the Fed, or the ECB, buys a bond, they're injecting fresh money into the market, and that fresh money is really nothing more than a representation of debt. When that structural belief is broken, that's when the fragility surfaces instantly and, brutally. It imposes crushing austerity, as we've seen in the crises in Greece, Argentina, and Sri Lanka.
That's a compelling point, but let's look a little closer at the nature of the creditor, which I think provides significant stability. The reality is that the world largely owes this debt to itself. If we take the American example, the vast majority of that $38 trillion liability is held by American entities: U.S. banks, retirement funds, the Federal Reserve itself. This persistent narrative of being captive to foreign powers is frankly misleading. China's share, for instance, is only about 2% of the total. This self-contained structure provides a robust insulation against geopolitical systemic risk, and it gives policymakers much greater latitude.
Okay, but while it may be self-reflective, a hall of mirrors, if you will, we have to identify who is holding the key mirror here. It is not simply the system owing itself. Yes, the debt is distributed among pension funds and banks, but at the very apex of this debt structure is what we call the markets. This is the fourth and most potent layer, this institutional web of massive hedge funds, global investment banks, and central banks. These entities are the true judges of credit.
They decide which nation borrows cheaply and which has to pay these punitive interest rates just to survive. The stability you describe only holds until the markets lose confidence, and they are the ones with the power to impose austerity and, in some cases, topple governments.
I see why you emphasize that risk, but that risk is precisely what is managed by the debt structure as the safest asset. Debt is a constantly renewing subscription. Investors aren't waiting for the principal to be repaid. They are waiting to renew the deal indefinitely because the government bond is indispensable collateral. This rhythmic borrowing ensures stability and continuous liquidity. Japan is a perfect illustration of this. Its debt exceeds 250% of its national income. Yet, its interest rates remain near zero. Why? Because investors have absolute faith in the asset's safety. It's this continuous flow, driven by that safety premium, that ensures the global system functions.
I would caution against calling that stability. The language used to describe this dependence is, I think, far more critical. It's an addiction. The global economy is fundamentally addicted to the rent, to those guaranteed interest payments. If the fuel for this engine, which is the capacity for continuous increasing borrowing, ever runs out, the entire structure clogs up, and the whole system just seizes. This inherent, critical dependence on continuous growth in borrowing is by definition fragility, not robust stability. It is a necessary structural element, yes, but it forces an ever-increasing risk profile onto the entire world.
The political imperative, though, confirms the structural necessity of this continuous cycle. The central secret, which is known to all politicians, is that the goal is not a balanced budget. I mean, that's just a narrative they sell to the public. Their actual goal is to maintain the level of debt where faith is not lost. They must ensure the world believes the debt will be paid back, even though the plan is perpetual refinancing. The focus is entirely on managing confidence, because that management is essential for the state to be able to spend and to function.
And I agree completely on the political intention. Managing belief is paramount. But again, let's look beyond that intent and focus on the material result. Regardless of the structural needs of central banks or the political necessity of managing faith, the undeniable result is a massive systemic transfer of wealth. This mechanism guarantees that non-capital owners who fund the state through their taxes are perpetually paying interest to capital owners who hold the sovereign debt. This confirms the severe equity issues that are just inherent in the cycle, where debt acts as a consistent structural mechanism for extraction.
So, what we've established, I think, is a structural reality dating back centuries that dictates debt is the fundamental mechanism allowing the modern state to spend and the global economy to achieve necessary liquidity. Paying it down is not a viable option. It would liquidate the very assets that serve as the foundation of modern finance. Therefore, the focus has to remain on the expert management of interest payments and the preservation of the confidence that keeps this entire indispensable system afloat.
And while debt is the necessary heartbeat of capitalism, that heart is continuously fueled by the extraction of wealth from taxpayers, and it relies on an extremely delicate foundation of collective confidence. When that belief is shattered, it imposes crushing financial discipline, instantly revealing the severe fragility of the underlying structure. The stability it offers is conditional, and the price of that stability is perpetual extraction.
What we confirm today is just the profound complexity of modern finance, where liquidity is inherently tied to liability. The very essence of modern money is debt.
Exactly. And understanding this dynamic balance of structural necessity versus inherent risk requires viewing the material through both lenses. You have to appreciate the stabilizing function while also critically analyzing the inherent dependence and the powerful mechanism of wealth redistribution that defines the entire cycle.